Hello friends, and welcome back to Advanced Finance. Dr. E here. So I want to take a step back. We're on case 6, the lazy mower, and I want to do a little housekeeping. And I should have started the case by saying that what this is about is forecasting project cash flows. And I discussed this, but I didn't write it down for you, so I want to go ahead and write it down for you. What are the components of a business of cash flows related to a business or a project cash flows? And so the first thing we have is what we call OCF, or operating cash flow, and that's equal to EBIT plus depreciation, which is EBITDA, minus taxes, okay? And the taxes equal EBIT times the tax rate. And you take EBIT instead of pre-tax income, because often with pre-tax income, interest expense is subtracted, and you don't want to involve interest expense in any way. So you got to come up with operating cash flow. Well, how do you get EBIT? EBIT is equal to sales minus cost of goods sold minus SG&A minus depreciation. So you got to do an income statement, okay? Next, you have to do the money spent on working capital, okay? And that is accounts receivable, inventory, and accounts payable, okay? If accounts receivable goes up, that is cash spent. That's more money that you need. Accounts receivable go down, then that's cash generated. Money spent on inventory, cash needed. Inventory goes down, cash generated. Accounts payable goes up, less cash needed. Accounts payable goes down, cash, it's a use, more cash needed. Okay? Then you have money spent on property, plant, and equipment. Okay? So these are the components of a business, the components of a project. And now let's shift over to, I'm going to move the camera here, and let's shift over to the spreadsheet. Let me get this into focus here. All right, let's get this into focus. A little too big. There we go. I think you got it. All right. Let's turn the light out here so you can see that better. All right, and let's flip this here. I think, yeah, that looks good. Okay. So once again, I may disappear from view. I don't know. When I sit down, all I saw was the top of my dome there. There you go. Look at that. So I think I'm going to make these numbers a little bit bigger so you can see them. Hopefully you can see the whole screen. There you go. All right. A couple of other things that I did here. Change some of this. Property, plant, and equipment, money spent here. The change in net working capital is the additional amount of net working capital that is put in. And so the total cash flow in the initial investment period is the the 900,000 plus the 20 million spent, 20,900,000. Okay? And let's see, I turned these, I anchored these, and the reason is, so now we're going to look at question number 2. Question number 2 is to do a scenario analysis. And there are two ways to do this scenario analysis. One way is to use, under data, use the what if or the scenario manager. Okay, I don't want to get into that. Let's go ahead. I want to show you the mechanics of this. So let's go ahead. So a scenario analysis involves adding a best case scenario and a worst case scenario. And a scenario is when you change several variables in your financial forecast at the same time. A best case scenario for a business is when unit sales go up and price per unit goes up and cost per unit goes down, and that includes variable cost and fixed cost, and we're going to leave and rent, and we'll see what happens to our cash flows when we make these assumptions. So let's just go ahead and let's copy this spreadsheet to here, and let's call this best case. And let's go down here. Let's copy this. And let's call this worst case. There we go. All right, let's make sure that the numbers all look the same. All of our cash flow numbers look the same, and they do. Okay, so we've set this thing up properly so that we can copy it. All the numbers, anytime you copy a worksheet, check your numbers, make sure that they are correct. You don't want to be working on a worksheet that doesn't have the right relationships set up. All right, so under a best case scenario, here's what we're going to do. The unit sales will equal our base case times 1.15, because we're supposed to increase everything by 15%. According to the book, the best case, everything goes up 15%, and so we're going to increase our number of units. Our price per unit, same thing. So we could actually, I think, do this. Yeah. So what just happened is unit sales times 1.15, so it's C2, and here's C3, so this is C3 times 1.15, so our unit price per unit goes up 15%, so we're selling more units and at a higher price. Okay, so that goes up. All right, then that will flow directly into our revenue because it's already set up. All right, now what happens to our variable cost? All right, so our variable cost should go down. So let's adjust this. This is the variable cost. We'll multiply that by 85%. And our variable costs have gone down by 15%. And we'll drag that over here. Now, just to show you, B15, here is B15, $400. Okay? So our variable costs went down. And let's go ahead and leave our fixed costs and our rent the same. We could knock that down by 15%, but we're going to go ahead and leave that the same, and our depreciation stays the same, and we're going to go ahead and leave our working capital and the amount of money that we need for our property, plant, and equipment, we'll leave that the same. These are decisions that you have to make as an analyst. If you think you can cut your working capital by 15%, then you would do that. That's the best case scenario. If you think you can cut your property, plant, and equipment budget by 15%, then you do that, okay? But we're going to assume we're going to need the additional $900,000 in working capital, and that we're going to need $20 million worth of property, plant, and equipment, and we're going to leave our fixed costs the same and our rent the same, okay? Let's go ahead and just hide the income statement for a minute and do that so we can compare the cash flows, the cash inflows. And oh, by the way, you got to add this $4 million back in, so check your spreadsheet. The one that I posted did not have the $4 million added in here. This is when you sell the equipment at the end of the period for $4 million. All right, so that's an inflow. And because the equipment is completely depreciated, fully depreciated, it's an inflow of $4 million. All right. Oh, you know, if you do that, that $4 million would be affected by taxes. You've got to recapture that, so let's take that $4 million equals $4 million. Hey, $4 million times 1 minus 34%. Bada bing, bada bum, bada boom. There you go, after tax. Okay, because it's a gain of $4 million, you're going to be taxed on that. Everybody see what I did? All right. So let's look at the cash flows. We're going to have to, let's go ahead and, whoops, paste that there, and paste it there. Okay. All right. A little adjustment there. Okay, so let's compare the base case with the best case, and you can see that the cash flows are significantly higher. Let's go ahead and sum that. This includes, let's change this to C38. There's our, there are our cash inflows, and let's go ahead and do that here. And so we can see there's a very significant increase in cash flows. All right, so that's our best case. Let's go ahead and open up, unhide, there we go, boom. All right. Now let's do a worst case scenario, and this is going to equal, go back to our base case, times 0.85, 1 minus 15%. All right, let's drag that out. So our unit sales go down by 15%, and our sales price goes down by 15%. Let's make sure we get our formatting done correctly, and then we'll drag it over. So our sales price goes down 15%. Now our variable cost will go up by 15% in a worst case scenario. So it's our $400 times 1.15 times the number of units. So what happened to our variable cost? Let's just flip back here for a minute. Yeah, it went up. And let's drag that formula out. We'll leave the rent and fixed cost alone. and we'll leave the working capital and the property, plant, and equipment costs alone. And we could adjust those if we wanted, but we're not going to. And I think everything looks the same. And so now let's go ahead and look at the difference between best case and worst case. So let's hide this. And total cash flows. Boom. Wow. Okay. But I will tell you this. At least without doing our the time value of money, we still have positive cash flow. 67 million versus 21 million, 198 million versus 21 million, and 126 million versus 20.9 million. So even in the worst case scenario, now we could adjust, we could say the $900,000 goes up, we need 15% more working capital. We could say that $20 million goes up by 15%, that's another $3 million, we need $3 million, and would still have positive cash flows. Now introducing time value of money will change that, because remember, these cash flows out here are worth far less than these cash flows up here. So this number, once we introduce time value of money, this number will go way down, and so will this number, and so will this number, okay? All right, so let's open this up. Let's unhide this. So we've done a scenario analysis. Now, we can do a net present value. For illustration purposes, I think what I would like to do is go ahead and find the present value of each of these cash flows. Okay? So, let's say this equals this number divided by 1.14, and 14% is the number that is the cost of the weighted average cost of capital that we're given in the case. It says on page 62, the weighted average cost of capital, 14%. And we're going to raise that number to the year. All right, so this is what you would pay today for this number in a year. Now, let's go ahead, and we don't want any cents in there. It takes up space. We don't need that. All right, so let's go ahead and drag that out. Boom. Okay, so now let's go ahead and see what our cash inflows are. Told you it was going to go way down. All right. Let's just double check. Yeah, looks like all that's good. And so let's do a net present value. Net present value is equal to our cash inflows plus our cash outflows, which is a negative number, so that makes it a negative number. There you go. So here's our net present value under a base case scenario. Now we could use the NPV function, okay, to do this, and here it is. Okay, we could put 14% and put all the values in, and we'd be good to go. But I would rather you see how we got the net present value. It is the present value of the cash inflows minus the present value of the cost. All right, so let's go ahead and let's go ahead and copy that. Now we have it, so let's go ahead and copy it to right there. Let's make sure it's grabbing the right numbers. It's C38 divided by 1.14 raised to the to the C21. And let's just, let me get my calculator out. Let's just hand check. So we got, let's do year 2. So we have, let's clear this calculator out. A cash flow of 21, 234, 480 divided by, open paren, 1.14 yx2, close paren, equals 16,339, 243. So we're good to go. That number checks out, so we're good to go. And so let's go ahead and copy that one more time and put it here. Okay. And we can go ahead and copy our net present value formula and put it here and put it here. We'll call this NPV. And NPV. All right. So let's look at our base case net present value and our best case net present value and our worst case net present value. Okay? Now, let's go ahead and add an internal rate of return onto this thing. How about that? Let's add a row. Give ourselves a little breathing space here. Insert a row. We don't need to down there. And let's say, so, the internal rate of return, okay, equals IRR. And we're going to put these cash flows. No, we're going to put these cash flows. Equals IRR. And we'll put the present value of these cash flows in here. We're not done yet. But there we go. All right, bear with me as I go through this. And then a comma and a guess, and let's say it's 20%. All right, we may have to put a point to. No. All right, what's the problem here? Equals internal rate of return, C19. Well, we may just, no, I think we just need to put the